Okay, the gang is all here, and thank you very much for joining us this morning. My name is Steve McMenamin. I'd like to welcome you to today's event, which is part of the continuing series of the Greenwich Roundtable. Our topic this morning, Asset Allocation for 2017, Navigating the Risks, Charting the Opportunities, is our annual symposium for the Chief Investment Officer. A session we hold to hear how the leading lights practice their craft. We started holding this discussion at the end of the third quarter because in the old days, investors were required to give 90 days notice to redeem by the end of December. Nowadays, lockups have lengthened, but we keep meeting early enough to figure out which strategies to buy and sell. Today, we'll hear from three innovators, all very different from one another, and I'll briefly introduce them alphabetically after I say this. The speakers' views are their own and don't necessarily reflect the views of the roundtable, the members, or the board. And having gotten that out of the way, I'd like to introduce Clark Cheng. Clark is the Chief Investment Officer of the Merrimack Corporation. Merrimack is a single-family office based in Stamford and one of the original roundtable members. Before joining Merrimack in 2014, Clark managed the giant hedge fund book at HSBC in New York. Before that, he performed hedge fund research at Guggenheim Partners and hedge fund due diligence for Morgan Stanley. Among his academic achievements, Clark's undergraduate work focused on psychology and the behavioral sciences. Sitting to Clark's right, Lila Honeywell is the Chief Investment Officer for Boston University, where she runs that school's endowment, as well as advises the Investment Committee of the Board of Trustees in establishing risk and return objectives and investment policy. Before BU, Ms. Honeywell was a managing director at Cambridge Associates for over 20 years, where she advised families and not-for-profit organizations. Before Cambridge, Lila was an investment banker with Brown Brothers Harriman. She currently serves on the Board of Overseers and the Investment Committee for the Museum of Fine Arts in Boston and the Board of the Boston Athenaeum. And sitting to Clark's left, Gustin Oliveros is the CEO and CIO of KAUST Investment Management Company, the investment arm of the King Abdullah University of Science and Technology. KAUST is a graduate-level research university in Saudi Arabia, which started operations in 2009. Before that, he managed a $100 billion portfolio for the World Bank's pension fund, medical plan, and its various endowments. He also advised central banks, foreign pension plans, sovereign wealth funds on strategic asset allocation. Before that, Sindhu ran the adjustment program at the International Monetary Fund. Sindhu was a member of the Sequoia Heritage Fund Board, the Rockefeller Foundation Investment Committee, and the United Nations Pension Plan Investment Committee. And today's moderator of the Greenwich Roundtable is Ray Gustin, a managing director of Drake Capital here in town. Mr. Gustin is also a trustee of the Roundtable, where he is completing his third tour of duty as the chairman of our programming committee. So please welcome Ray as he sets the table for today's discussion.
Very good. Thank you, Steve. The CIO's job has certainly gotten tougher in recent years. As we all know, in a world of increasingly managed global policy rates, we've all been working overtime to uncover the holy grail, attractively priced risk assets. Said a different way, to deliver portfolio returns in line with an institution's historical expectations, many CIOs have felt, implicitly or explicitly, increased pressure to move out the risk curve. A decade or so ago, we often sought to convert some of our portfolio beta into a mix of alpha and beta through the addition of hedge funds and other alternative strategies. Over time, institutions increasingly embraced the endowment model, adding more alternatives and private capital to their portfolio, and we sought to improve the efficiency of this shift in the asset allocation mix through manager selection. Often these steps worked. So where has all the alpha gone? Has much of it been arbitraged away, never to return? Or are we struggling through the end of a cycle where extended valuations in many asset classes have concentrated good ideas into crowded trades? If that is the case, will strategy and manager alpha return in abundance after a washout in one or more asset classes? That is the hope of many managers and quite a few CIOs. Of course, that scenario carries many risks for the institutional portfolio. we need to ask a number of tough questions, including the following. What changes, if any, should we make to our portfolio construction rules to target an acceptable risk-adjusted return profile in this environment, and also to permit us to take advantage of a change in investment regimes when it inevitably comes? This morning's front-page Wall Street Journal article entitled "Central Bank Tools Losing Their Edge" may spell the beginning of the end of the Great Reflation experiment. Second, how can we properly evaluate our current set of managers, as well as prospective new managers, when recent results are likely disappointing for one reason or another? It is very difficult to evaluate our original selection hypothesis when the environment has changed. Were we wrong about the risk environment? Or were we wrong about the manager's ability to generate alpha, or both? Should we modify our manager selection criteria to account for the current investment environment and the more crowded manager field, or stick with the approach that got us here and assume a reversion to prior norms? The challenge is that understanding behavioral biases may still not lead us to optimal decision-making unless some of the variables are stable. Finally, do our institutions have the patience for long-term investing as many profess, assuming today's low-return environment persists? Or has this been just a marketing pitch? When annual university endowment rankings make the front page of the business press, is anyone really investing for the long term? For those of us who can invest with a long-term horizon, are we really prepared to add illiquidity risk to our portfolio or to enter into longer-term arrangements with managers if we can lock in a much better share of the gross return for ourselves? This is a challenging time for us, and as we know, all such portfolio decisions are interrelated. We need to fully evaluate the past and the present, but invest for the future, since changing the profile of an institutional portfolio takes some time. Thankfully, we've got an experienced and talented panel of CIOs here today to take us through the elements of their approach and their views on opportunities and risks as they scan the investable horizon. Lila, Clark, and Sindo each represent institutions with different requirements for portfolio current income, the investment horizon, and acceptable risk. Lila, why don't you get us started today?
Thank you, Ray. Can everyone hear me? And raise your hand or wave if you can't. No. Okay. Is that better? Better. All right. So I'm the long-term person at the table here, and I want to talk to you a little bit about BU's history because it informs our ability to have a long-term view. So the university is the fourth largest university, private university in the United States. We have $2 billion of annual revenue, and the endowment is only $1.5 billion, or 1.6. And you say, how can that be? Well, we had no development office, no annual fund, no capital campaign, no alumni function, because for 30 years the university was run by someone who preferred to not be told what to do. So he grew the university. People know who I'm talking about, or are chuckling. So he bought 2 miles worth of real estate with debt. So we're single A rated. We'd like to stay single A rated, so that's part of our criteria. And the debt is about $100 million less than the endowment. So when we're at 1.5, it's at 1.4, et cetera. The endowment was therefore didn't matter. Currently, it's 2% of the operating budget, so it still doesn't matter, which makes my life particularly lovely. And historically, it was run by one committee chairman by fiat for 30 years. He grew the endowment from 18 million to just under $1 billion. He did that with, I think, the right strategy. It was 45% U.S. small cap aggressive growth, 45% emerging markets, and 10% privates, which were good managers but done on a momentum basis, so bad vintage years. When the tech bubble crashed, we were last in the universe of colleges and universities, and the next year we were the bottom 5%. Everyone said, wow, we just lost a lot of money, even though in the context of the university it didn't matter. So he was asked to diversify. He did, which locked in the losses. So he chose to eliminate the U.S. small cap growth and keep the emerging markets. So from 2002 to 2007, we were top or bottom based on what emerging markets were doing, which was mostly top. In 2004-05, the university's board had a revolution. They hired a phenomenal president who has the ability to run the university on all fronts and do everyone who reports to him's job, and said, make it best practices. He started a capital campaign for $1 billion from a place that had recently found 303,000 living alumni who'd never been asked for money. So capital campaigns is success, but he said, I need an investment office because we have to, if we're going to raise this money, be good stewards, potentially better stewards of our capital than we were before. So 2007, the office got started, got a committee that functioned as a full committee. It took a couple years for this gentleman to retire. He was 89 at the time. So my predecessor managed that process. So when I came in 2011, fully diversified, I like to say she made a beautiful chocolate cake and I showed up to put some frosting on. It's a long history, but you need to understand that context. So how do I think about investing? I have some key underlying tenets. One is if you diversify, you will stay relatively rich, but if you concentrate, you can get rich if you're in the right strategy. So we were in the concentrate, be in the right strategy mode before. Now we're in the diversification, stay rich, be good stewards of capital. I do believe in regression to the mean. I think you need to rebalance to control risk. And so we have delegated authority in our investment office to do the rebalancing within a set of what we call rebalancing ranges. And I think that the pace, the frequency of that rebalancing should be a function of the volatility and the momentum in the market. So it should change as being supposed to be formulaic. I strongly believe that asset allocation should reflect the operations, financial structure, and constituents' risk tolerance, which is why BU is a great place for me to be. Our history allows us to do that because we're not in the nuclear arms race of comparing our return to another institution's return, because if we'd done that, we'd have been terrible for 15 years. So nobody does that. Risk matters if you spend, and correlations are not stable, and bad things tend to cluster. And those three statements are going to inform where we start our asset allocation process that I'll tell you about in a minute. We are an institution seeking to grow our endowment, and we exist in perpetuity, so we have a very long-term horizon, and equities broadly defined do dominate our asset allocation. They're 90% of our asset allocation. I believe that asset classes behave in certain ways in certain markets and therefore have roles. And how I keep our committee and our whole organization comfortable with our asset allocation is we spend a lot of time ahead of time talking about what those behaviors are going to be, and therefore, and the fact that they will be in and out of favor, guaranteed, and that within a diversified portfolio, managers in asset classes, there's always something doing well and always something not doing well. And if I set it up that way, then we have the patience to say, see, we told you it was going to happen, and this manager has not changed what they're doing. We still have very high conviction we're staying. Or the purpose of this asset class in our portfolio remains unchanged. It's not doing well, it's staying. And then you have to recognize and teach your constituents that performance measurement is beginning and endpoint sensitive, and if you roll a quarter or a year, you can have a radically different picture. So I spend a lot of time showing them that and getting them to understand that. And I think the most important part of my job, having set an asset allocation that's appropriate to my organization, is to make sure we keep it for over 20 years. There's a lot of ways to win in the investment world, but the sure way to lose is to change your strategy over and over again, because inevitably you succumb to pressures and you change it when you're selling it low and buying the new shiny thing that's at a high and just locking in your losses. Okay, so how do we do asset allocation? Well, actually, one more thought. We have a diversified portfolio. Told you I like to educate people, make sure they understand what's going on. So if you look at the leadership of a concentrated S&P portfolio versus a diversified portfolio, it's cyclical historically. So from 92 to 94, diversification won. From 95 to 98, the S&P was king. 99 to the spring of 09, very long time frame, diversification won, which is when a lot of us grew up. And then since the spring of 09, the S&P has been winning, based on the global investor psyche of America's safe, buy bonds, stocks, cash, et cetera. That's going to revert. I don't know when, but my job is to keep our diversified portfolio in place until that reversion happens and survive in terms of providing annual coverage of our meeting our annual liabilities. So how do we start about asset allocation? We have a very broad approach. We have 5 objectives. We want to maximize our return because we're only 2% dependent on the endowment. That means I want privates, emerging markets, and small cap. We want to meet our annual liquidity. which is our spending plus some percent of uncalled capital. That means I want cash and long-term treasuries. We have a 15-year constant duration portfolio of treasuries. It's 6% of our portfolio. We have 4% in cash. I need to make sure Moody's metrics are fine with our single A rating. That means I have to focus on 30-day liquidity. That's a piece that's important to them. Cash, bonds, and stocks. I don't want to blow a covenant. That means stable NAV, hedge funds. And stewardship. Want to make sure that my boss, the president, is able to raise the $1 billion. He actually blew through that 2 years early and has now changed the target to $1.5 billion, so he could sell snow to an Eskimo. But that first capital campaign means I have to make sure that we are perceived as good stewards of the capital. That means, as he says, don't be in the top decile, because to get there, you have to be in the bottom quartile. So we want to be median to top third every year, and then we'll compound in the top third over multi-periods. That means diversification. That's actually the winning strategy. I mean, all these things together mean be diversified, but it's more important for us to raise that capital than for us to have an extra 1% return given the 2% endowment dependence. Implementation. There are two gating questions that we use. The first is, how many years coverage of that estimated annual liability do we want? When you have to send money to your operations or to the private managers, no matter what the market conditions are, you need to be in the place where you're not selling a depressed equity to crystallize that loss into a permanent loss. For us at BU, the answer is 1 year. So that's how we get to our 10% in cash and treasuries. I use 40% of the uncalled capital as the estimated liability. You all say that's never going to happen if there's a crisis. That's right. So my 1 year is really 2 years, or somewhere around 1.5 years, depending on how long it takes for the private machine to start up again if we have a crisis. The second question is, having done that, the rest of my 90%, how am I going to make money? So given our time frame and the inefficiencies in the private markets, we would like to maximize our allocation to privates. Two problems with that. Access. We're late to the game and our privates aren't the best quality. So we're starting over. It's basically a reboot. And we have to think about liquidity ourselves. All people who have very large programs, private programs, have access to a line of credit and are usually AAA rated and can issue taxable AAA debt if they get into a liquidity squeeze. We can't do either because A, we're single A rated, and we do have a very large line of credit, but it will be used for our private. It will be used to support our debt if there's a crisis. So I have to manage our liquidity for the endowment as a tub on our own bottom. Therefore, I spent a lot of time thinking about how big can the privates be. If you run a scenario analysis from July of 2008 through February of 2009, and you look at various levels of privates, you can do 25% and not get in a just complete bind where you have to tap those extra resources to cover your liquidity. Therefore, our max is 25%. Over time, as we grow and our debt becomes less, then we will switch that number because it's not set in time. We also think, starting from scratch, that 25% is a healthy number, and we really wouldn't want it to be 30% because of the access questions at this point. I actually report to my committee. The first thing I say is our EIM is 70%. What is EIM? It's a term I made up. Expanded illiquidity metric. It's a shorthand measure that captures the NAV on the privates, the size of the hedge funds, and I mean any hedge fund format, not just something that might be designated a hedge fund in a bucket, and uncalled capital. Why do I care about that? Well, my 25% of target privates, if you're maxed out, you probably have another 25% of uncalled capital, because your uncalled capital should be half to 1x your target when you're full up. If you add those things up to 70% and you have a 2008, 2009 crisis, I go to about 94, that number goes to 94 or 100% of the value of my endowment. The folks that got in trouble, that number was 90%-ish before the crisis, and it went to 140 and 160% of their endowment by the September, October of 08. So that's how I think about it. Okay, how am I doing on time?
You're good. A couple minutes.
Okay, so what does our asset allocation look like? We have, as I said, 4% cash, 6% long treasuries. It is a 15-year duration. Yes, I know interest rates are supposed to go up, but it is an insurance policy, and if interest rates go up, I hope to make a lot more money on the other side of my book. We think about asset allocation in terms of behavior and roles. So we have a growth bucket, which is our long equity, our long short hedge funds, and our venture PE and special situations. We then have which is 57% total. We have a natural resource bucket, which does include privates, which is about 12%. We have diversifying hedge funds. Those are people whose returns are tied to events and have less equity beta. That's 16%. We have an opportunistic bucket. It's 5%. I do believe you should have the opportunity to not only add value by selecting managers, but by going to places that aren't in your policy or overweighting things that are in your policy. And that was the solution for BU. You could be like Harvard. Jack Meyer used to change his policy. He used to say it was a 20-year policy, but he'd change it every 2 months when he wanted to change his asset allocation because his comp was, and everyone else's, was tied to outperforming their benchmark. You can have no target and have a wide range and then have a shared agreement about where you want to be as market conditions change. At BU, because of our Wild West past, we have a dedicated 5%, and we have conversations about whether that should be offense or defense. It has gold in it now, it has cash, and it has extra Japan. And then the 10% in the cash and the fixed income. Matters matter. Managers matter. So asset allocation, academic studies say drive your return. But if your asset allocation is quite similar to everyone else's, then all that matters is managers. So we believe both are very important. And we've been changing as we grow. We've been improving our staff and improving access to managers by those changes. What are we looking at today? We've committed to some small mid-cap private Brazil. We're always looking for emerging markets because we have a 13% allocation, and I think the opportunities are evolving and the manager offerings are evolving too. We're revamping our hedge funds. We think about them as offense and defense with the new colleague that we have who was the co-head of Cambridge Associates Hedge Fund Research and worked there for 18 months. He just came this July. We're moving to smaller mandates, and we're also thinking about who's going to survive and how can we capitalize on the fact that there's a big sucking sound of capital coming out of hedge funds. That is a huge opportunity for a latecomer like us, and we're excited about that. In addition to the fact we think that there'll be less capital, so there'll be more opportunities to make money. And we're building our privates. We're taking a 20 to 30, 50-year time horizon. We've got a gentleman who was at MIT for 25 years doing privates there, and he's very excited to be using his expertise to find smaller organizations, newer organizations, and invest at a scale that he couldn't do with MIT, given how large they had grown. Our competitive edge, as you can therefore tell, is that we're relatively small. We're very long-term. We don't have to be in the nuclear arms race of absolute return, and we can really offer real partnerships to those managers that matter and be contrarian, be value-oriented, give them capital when everyone else is running. We do use futures to rebalance and get beta and ramp up our momentum exposure because they're tied to cap-weighted indices. And our partners where we trade say we are always buying when the futures market is selling. And I think that's awesome. And I guess the last thing to say, to address what you were saying of how are we going to earn what we spend, I think that's the wrong question. It's how's the organization going to cut their spending? And if you think about the 70s, the real purchasing power of the endowments killed itself because it couldn't keep up with the inflation. And the choices there on what you didn't spend were professors and a little bit of financial aid, but professors and buildings, right? If you're a university. And the buildings, deferred maintenance, if you all are old enough to remember, those dorms looked like they were falling down. The classrooms were the pits. It took until in the 80s the wealth got created, but $1 invested in an endowment at the beginning of the 70s did not recover in nominal terms until the mid-'80s, and in real terms until the mid-'90s. And if you think about the sort of what I also call the arms race of facilities, think about the 90s. Building, 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 rehab, rehab, rehab. It took 25 to 30 years for the campus to recover. Now the question is faculty, financial aid, and buildings. I'm sure buildings are going first. Depends what the pressure is about which of the other two go next.
Very good, Lila, thank you. I just have one brief question. We'll talk more about this, but
Okay.
emerging markets.
Yep.
You've got a large allocation. Just give us a little bit of a sense of your view now for this allocation to Brazil. How are you thinking about that?
Oh, Brazil's cheap. Okay. That's a really insightful observation, right, guys? How are we thinking about it? So it is a piece of our growth engine. If we could do venture and privates at a higher level, we'd probably have less emerging markets, right? So it is a compensation for the fact that we're limited at 25% on our liquidity perspective and also access to managers we'd like. How do we do emerging markets? We've got passive. We have people who are sort of sector benchmark aware, but not driven by the benchmark, moving their capital across the globe, because I think it's a question of countries, sectors, and companies. We have regional managers and we have country managers. In the public side, in addition to the 13%, we have private emerging markets, which is another 3-4%. So I'm thinking of it as a lot of people doing a lot of different things, not eventually correlated with the low monetary regime, clearly affected by capital flows with the risk off, but just getting cheaper and cheaper, and it's almost all active, picking off companies of quality.
Very good. Thank you. Let's hear about your portfolio.
Okay, so I'm really different, and I've gone through a lot of changes over my career and stuff. I mean, I think investing is purely an art, and I've tried to adapt and change along the way. But I came from a bank that was very institutional. We did a lot of valueless work, a lot of checklist stuff, and a lot of it's basically covering your ass. And I think when you're in an institution, you have to do that because you have to protect the business, and you have to worry about things that shouldn't matter in reality if you're just trying to maximize wealth and stuff. So it's been a large change. I mean, one of the things I think the institutions and people talk about is concentrating their portfolios. And at the bank, we were concentrating our portfolios, but it's partially a result of the fact that we're losing resources, so we're laying off people. As you lay off people and as your checklist gets longer and longer, you can't diversify. You can't add more managers. You have to go more concentrated. So the marketing pitch is one way, but behind the scenes, there's a reason why we had to go more concentrated. So that's where I came from. And over the last 2 years, I've been at a family office. I'm on the opposite extreme of where I was before, whereas all we have is one goal, which is to maximize wealth now. And we don't care about many things that I used to care about before. Like, for example, we don't care about reputational risk. To the extent that you stay in a fund that has a possible litigation or SEC investigation, at an institutional shop, you kind of have to sell it early, just in case. Because if it is negative, you're going to be in the press. Versus now, chances are, if you don't believe that it's going to happen, if you don't think the negative impact is going to happen, you can actually stay in it all the way to the end. And chances are, in most cases, it was better to stay in the end because all those cases that investigated got overturned anyway, besides a couple. So we're quite lucky in the sense that we have free reign to basically invest and compound wealth. And I do think this it's a very soft kind of art. I have a weird background in the sense that I think about everything from a behavioral perspective. So I was working on a master's in psychology, and I think people will do exactly what they're incentivized to do. If you can understand that, you'll understand markets, hedge fund managers, and everything better. People will do exactly what they're incentivized to do. And I'm also fairly quantitative in the sense that I think about the world in terms of probabilities and distributions. There's no perfect information out there. So if I have perfect information, if I knew what the next 12 months covariance matrix was for my portfolio, and I knew the return and risk for the next 12 months, I could do it with 20 managers. But the thing is, I don't. I know I don't know it. I don't think anyone knows, and I could care less about historicals. So the way that we think about it is that, I think about the long term, but I try to manage for the 12-month, because anything beyond that is just really uncertain, and just things happen you just don't know about. Things come out of left field all the time, and you just don't know what's going to happen. So the way that I think about it is we're trying to create our own Sharpe ratio. So we're investing in, and just to put things in perspective, we have private equity and real estate, which we don't do much in. So last year we did one real estate transaction, but outside of that, it's illiquid, and there's not much you can do about that in the interim. So I try to focus most of my time on the long-only side, fixed income and equities, and also hedge funds. So from that perspective, we're looking for high-vol, high-return managers, and which would normally be scary if you were running a concentrated portfolio. But we're looking for high-vol, high-return managers that are truly uncorrelated ex-ante. The thing is, you don't know what that is. So the way that I look at it, I look beyond the asset class or the strategy level. We go down to a factor level, because factors, correlations are more stable. So I think of every manager as basically having a list of factors. And what I'm trying to create is a balanced and diversified factor portfolio. And if they're all high vol, high return, and they're diversified across different factors, I should be able to generate a higher Sharpe ratio. So as an example, within our TMT bucket, within the hedge fund portfolio, we'll have 2 growth guys. We might have two low net trading guys. We have a guy that specializes shorting in Japan, and I'm looking at another guy who does Pan-Asia. But that would be our TMT pod, and they're diversified across multiple factors, across regions, styles, and strategies and stuff within TMT. So, and we're building this up from a strategy, geography, sector level all the way up, which is why we end up with over 100 hedge funds. As an example, under credit, we have a long only. We have a distressed credit portfolio, which is fairly long only in terms of credit, and I can't trade that. I can't make tilts towards that, because you can't leave and come back. Like, you can't sell out of Redwood and come back in later. It's just not going to happen. You have to stay in there forever. But the last distressed fund I added is 100% net short credit. So if they're both up this year, and one's 100% net short credit, and the other guys are very net long credit, I should have an uncorrelated, distressed portfolio going forward. That's kind of how I think about things. But I would love to be able to measure this with perfect information. I just can't. I know I can't, so I understand that. And I try to think about it all in terms of just probabilities and what I think will happen going forward. So it is fairly an art. The other reason why we're diversified is having done this for like 15 years and looking at managers. No one's perfect. We all make mistakes. And even if we could pick managers 60-40 or 70-30, the more concentrated you are, the more likely you'll be 50-50, or worse than that. You need numbers for the statistics to work out. I actually hated math when I was in school, but in hindsight, math and statistics are so important in terms of understanding correlations, distributions, and probabilities and stuff, which is how I think about everything nowadays. So we try to stay diversified because we're trying to have the statistics work out over time. I think, in terms of the results, I think what we end up with is that we have a portfolio that, on the downside, is similar to a conservative, say fund of funds on a hedge fund portfolio, or just a conservative group. But on the upside, we have a lot more return because we're investing in high vol, high return managers. But the key is to basically maximize that covariance, that correlation benefit. And I think that's the only free lunch in this business. Everyone tells me about strategies that are high Sharpes and all this other stuff, but if I talk about manager selection a little bit later, you don't get nothing for free. I think diversification is the one thing you do get for free. But if you have a Sharpe ratio over 1 as a manager, you're quite good. If you get over 1.5, there are exceptions, but for the most part, you're probably a fraud, or you're taking a lot of risk. And the key is always to understand how much risk you're taking to generate the returns, even though you're doing high vol, high return managers. The risk you want to avoid are like negative skewness. And that comes from finding managers that are short vol, or short liquidity, or short credit. So the most extreme case of this is like direct lending. And I get emails from third-party marketers in direct lending all the time. The Sharpes are like 7 or 8. There's no downside. It's uncorrelated to your portfolio. And all that is true because they just don't mark their portfolio to market. So if you don't mark your book, obviously it's uncorrelated, it has a high Sharpe ratio. But the question is always, you always have to think about that scenario where you always have to think about the worst case. You don't think about the best case. In the best case, everything's fine. Everything works fine. We're all happy. when markets are going up, everything is fine. But in the worst case, what's going to happen? And in that case, what is that portfolio worth if you had to sell it to pay redemptions? The thing is that you can't sell it. If you did have to sell it, it'd be 50 cents on the dollar. And a lot of people got into trouble with this back in '08, and I think a lot of people will get into trouble with this again going forward, because all these funds are raising these assets with a huge asset liability problem. So those are some of the things I think about from a high level, from a portfolio perspective. So it's interesting. Working at HSBC, we were concentrated, and we had to know what we're investing in for sure. We had to have high conviction. We're putting in hundreds of $1 millions into a manager at a time, and I found that very stressful actually too. Like, you have to know for sure, and in reality, no one really knows. You can do as many meetings as you want. You really never know. And because we're so diversified, I can actually sleep at night because I don't worry about any one manager taking me out. The managers that we have that are very large, we've had for like 15, 20 years. And I'm very comfortable with them. Those are our largest investments. But for looking at new managers, it's nice to be able to see a manager in a week and be able to invest the next month or two. And in a lot of cases, some of the best stuff I find nowadays are cases where a manager will call you that you've wanted for a very long time and says, look, someone just redeemed, I have capacity for 10 million or whatever, but you have to take it on the spot. At a bank, you can never do that. You just can't react that quickly. You have an investment committee, you have a process. Here, we don't have any of that stuff. So if a manager calls that's been closed for a long time and offers me that capacity, I could take it right away. And I think being nimble and having permanent capital allows you to be dynamic and take advantage of that kind of stuff. And that's stuff that we can never do when we're at an institution. So I think all that stuff is helpful, and I think all that stuff helps in terms of generating returns for us. In terms of a manager selection, it's funny. I think every hedge fund out there is pitching you, and it's a marketing story. And over the years, I think all the questions and you know all the answers too, actually. Everyone says they buy low, sell high. They have a fundamental approach. It's a P style. I think you've heard it all. In the end, I think stock picking is actually, I don't want to say it's completely worthless, but it's almost worthless in the sense that if you can't pick stocks, you're not going to be in the business very long. Like, you'll be out of the business quite quickly. I think the difference between finding the best managers and the worst managers comes down to strictly slugging, meaning sizing up your winners and sizing down your losers, and then managing your risk in the portfolio and overall portfolio risk management, which is your net exposure and then your gross exposure and that stuff. I think if you talk to most managers, their hit rate is probably only like 55-45, meaning they're not really, like, the performance wouldn't be that good unless they can actually manage a portfolio. So, and it's funny, when you do meetings, you can't know for sure how people will do. I think you give them scenarios and they'll tell you what they think they'll do. If you have a track record, you could ask them how they manage the portfolio over different periods of time, and I think that's very helpful. But a lot of times, like, I'm a reference for a lot of funds that I've known for 10 years, and I tell them, like, if for funds like Renaissance or funds like Third Point and stuff, after one meeting, I really don't know, like, the answer to every question. But over time, after spending 10 years investing in some of these funds, you can see how they trade. You can see when they get into trouble what they do, and you really don't get that just from one meeting or even 10 meetings in a short period of time. You really just know it over time. I've seen some of these guys where the good guys, they don't get psychologically biased. They don't fall in love with their stuff. And if something goes down, someone like Dan will just sell out of it. He doesn't care. And I've seen some very smart fundamental guys who I'm invested with too, which will constantly double down. And it's interesting watching all these people and stuff. But over time, I think, is when you really get to know a manager well and you can size it up. But if you meet the manager for the first time, I don't think you know for sure. And everyone's telling you a story, and you're always trying to pick it apart. But it's also an art too. So we have quite a few funds, and I try to be very efficient. So I don't have to take notes if I don't want to. I don't have to enter exposures on anything if I don't want to. These are all stuff that we used to do at the bank with a huge team, but I think most of it is valueless work. I think as an 80-20 guy, I don't think you get as much out of it as you do just focusing on the important things when looking at investments. Let's see. So I think it's funny. Yesterday we had a factor presentation at Morgan Stanley, and factors have been around for a long time. And there's been some very smart people who wrote papers about this forever. And yesterday, that was probably one of the most crowded sessions. Yesterday was where people are trying to understand what factors are. And one guy actually asked the question, what's an asset class versus a factor? And I'm thinking, if that was a hedge fund manager, I've got to sell out of every hedge fund who's in this room right now, because if they don't know what that is now, they're in big trouble. I think factors are the right way to look at managers. I think whether managers I don't mind paying fees to managers, for factor returns. I understand that. I want them to have alpha and stuff, but the key is not to be invested in too many managers with the same factors, and a lot of the factors you can actually get for free now with indexes and stuff. The question is, should we be moving towards a model where we're investing in that stuff passively? And I think that's a difficult question. I can allocate, but the minute you start doing things in your portfolio that are different from that, you become a macro hedge fund, I think. So when I looked at hedging last year, in terms of whether you want to buy like a put option, it sounds like a simple decision, but say you have a put and the market goes down, what do you do at that point? Do you sell it? Do you harvest it? Do you roll it? Do you keep it? The thing is, that's a question that a hedge fund would do, or a macro hedge fund would do, but that's not necessarily what I would be good at. Whether we want to go 50% to cash or not, I think is a macro decision. And in hindsight, I think it's better to be able to tilt the portfolio as a CIO. But if you want to make those big bets, you become more of a macro hedge fund, which is why we're paying fees to these guys to do in the first place. We have long only and we have hedge funds. I think hedge funds, in my mind, are better in the sense that it's an unconstrained investment process. Like anytime you constrain the investment process, it's not good for the portfolio. The question is, can you find people that can actually use that to their advantage to generate wealth for you? I find managing a long only very easy, actually, for these long only guys. They're all benchmark, and if the market's down 10, they're down 9, they're quite happy. And that wouldn't make us happy as we try to compound wealth, but I like hedge funds because it's an unconstrained investment process. In terms of manager selection, also, like our job is to pick the top quartile managers. I think over different periods of time, you have to take what you can get. If you look at this dispersion of returns for strategies, and then for sectors, at certain times you can make a lot of money picking the top managers, but at other times you really can't. So if you look at pre-08, like honestly, we could have thrown darts at managers, and we would have all performed very, very well. Because for the most part, the distribution was positive, and everyone was doing very well. After '08, if you look at the dispersion of returns, the top decile quartile was down significantly, and the bottom quartile was really bad. So in that case, you're trying to avoid returns. I think over the last few years, that distribution has gotten tighter. I mean, yeah, even if you pick the best manager and avoided the worst manager, it's harder to differentiate from manager selection. I think it's become very hard. So I think in that sense, it comes down to allocating to the right sectors at the right time or the right strategies. But I think if you look at the dispersion of returns, you'll understand how much value you can get from selecting the right managers, avoiding the worst managers. And sometimes it's not that good, and sometimes it's very good. If you look at healthcare as another sector, every healthcare fund over the last few years until the last, 18 months has done spectacularly well. And even if you invest in the worst hedge fund manager, you're still positive, actually. But if you invest in the best one, you're doing a lot better. But you kind of have to take what you can get from the market and understand kind of whether you're doing a good job or a bad job. But in reality, the only thing you could do is to invest in the top quartile of managers. You try to stay balanced and diversified across the strategies. We do have certain tilts, so we are tilted a little bit away from long share credit because I worry about liquidity. We do have more lower net stuff. I've always had a lot of quant stuff because I like quant and I like stat arb. I think that stuff will, if there is a downdraft, I think that stuff will be better in the sense that it's liquid and it doesn't have beta exposure. And a lot of people don't understand quant. They don't know where the returns come from. Quants know exactly where the returns come from. They know exactly what factors they have. They know exactly where the returns come from. The people that don't know where the returns come from are the fundamental guys who think it's alpha, but a lot of times it's just some kind of factor, whether it's value or growth or momentum or something. So we do a lot of quant stuff. In terms of the industry view, it's interesting. So in 2011, we had about $2 trillion in the industry, and right now we have about $2.9 trillion. A lot of that growth in assets came from institutional investors. In terms of private banks high net worth, that was about 650, I think, for pre-07, and then or pre-11, and then for family office about 350, and they were always fully allocated to hedge funds, I think, for the most part. I think the institutions are what came in over the last few years, and all the assets has gone to basically the top 20 hedge funds. Because they make large investments, it's hard for them to do a bunch of small investments. They have to invest $100 million at a time in large funds. I think that's changed the industry quite a bit. I think for one thing, I think as institutions they're more risk averse. I think hedge funds are taking less risk now than they have in the past. They're afraid to take risks. And the management fee becomes so lucrative that at some point, all you want to do is just protect the management fee versus trying to take risk and generate performance. And if you look at some managers, I think the industry is going through a change right now, and I think it's for the better. I would love it if $500 billion would leave the industry. And I think in the first half of the year, I think there was reports that $100 billion had left. I think a lot of those numbers are lagged because of these investor gates. And as a result, only 1/4 of assets are eligible to redeem any one quarter anyway. So if you ask the question, what's your redemption, I think it's a lower number. But if you ask them what's the redemption between now and the end of the year, or 12 months from now, it's actually a much worse number. The industry is starting to offer fee discounts, and good managers are just offering fee discounts in general. We're starting to get people that offer us the ability to invest at the low high watermark, which is ingenious because it's a temporary fee break. So you don't have to pay a performance fee for the drawdown whether you're in it or not. But once you get to the high watermark, they charge full fees again. But no one's complaining because you're on the way up. I think the industry is changing for the better now versus back in 08. In 08, I think the LPs had a chance to get together to force changes, but I think the market came back so quickly that no one actually did anything. I think currently the funding environment is very difficult, and as a result, I think the industry is changing for the better. So right now, we're starting to have scaled asset management fees. So as assets go up, the fee gets lower. I think that's good because it forces managers to continue taking risk as they grow assets. I saw a fund yesterday with a hurdle rate, which is nice to see. And some people have scaled performance fees too. So I think all these things are for the better. I think they'll incentivize managers to take more risk. If you look at, even Tudor, I think it's already in the press, but Paul Tudor Jones wrote a letter a few weeks ago stating that he was going to change how they do things over there, force managers to take more risk, if not take capital away. And I think that is all for the better. The whole industry, I think, isn't taking a risk. A lot of managers will have the right positions on, and then right before the quarterly earnings or right before some event, they take their risk off because they're afraid of losing money, which is very frustrating. And having a diversified portfolio as I do, I want them to take risk. You can't make money without taking a risk. I want them to take the risk, whether they're right or wrong. I can take that volatility, but I think the industry is actually going through a change, and I think it's actually better for everyone. In terms of behaviorism, it's interesting. If you understand how people are measured and how people are paid, you'll see exactly how people behave. And this is just generalizing, and that's not for anyone here. But in general, I think our institutional asset management business in the United States is completely dysfunctional. Because everyone is incentivized not to take risks. So as a CIO of a public pension, you get a salary. But if you take risk and underperform, you can get fired. And if you outperform, you don't get rewarded for it. So in that case, why would you take any risk? Why would you try to outperform? I think the one group that has it right is the Canadians, and I think they went through a period where they were desperate, and they basically said that as union members, we're going to start an asset management firm. The asset management firm are going to pay people market prices, and they're going to be managed by a board of investors. And as a result, I think they've done very well. But I think in the U.S., I think it's very problematic with how people have their interests aligned. And it's just as the last point, in New York City, the CIO job is only a 4-year stint. But how does anyone have a long-term outlook towards investment with just a 4-year life in your job? I mean, anything you invest in, you're not going to see the fruition if you do anything in privates or venture capital. Likewise, when you're there, all you're doing is you're getting the results of your past CIOs. So I'll stop there.
Very good, Clark. Please, Cindo, please take us from here.
Yeah. Thank you very much, Ray, and thank you for Greenwich Roundtable to invite us for the panel. We followed your activities over the years, and we very much appreciate what you do for the industry. Listen, as I was listening to my fellow panelists, I realized that we're in a very, very different situation. Thinking about what Lila said of financing 2% of the university budget, we are actually at the opposite extreme. I can be sometimes very specific about what we do because everything that we do is actually private, but the actual number doesn't matter. But the reality is that we have a much more challenging liability, which in addition to the percentage that we need to finance the budget, it has also some quirks which really make it very idiosyncratic. So when we approach portfolio construction, actually we have one. You have to ask yourself, what are you here for? Well, you're here to finance the university every year in perpetuity and to maintain the real value of the endowment. Now that for us is actually a tall order. It is not necessarily for all endowments, but for us is a tall order. And therefore, when you approach portfolio construction, you have to think about what is the combination of risk drivers that really would help you hopefully achieve that in the future. So the first thing we do is obviously we have to look through labels and asset class classifications and really think about, what are the drivers that you're putting in the portfolio. Just to give you, an example, when people talk about fixed income and think about safe haven, most of the fixed income allocations, certainly in the pension world, but also sometimes in the endowment world, include credit, include emerging market debt, include, things which are really, frankly, not what you expect to behave like a true safe haven when the equity markets go very badly. So, we have treasuries. We only have treasuries for that risk factor. And just to complete the picture, so for the equity risk factor, which is basically what is going to give, or risk driver, which is what's going to give you the return over the long term, it has the regular liquid, developed, and emerging market equity. It has private equity, but emerging market debt, REITs, long-short equity, hedge funds, event-driven hedge funds, all of that has some sort of equity component, and all of this has to be taken into account as contributing to the equity driver of the portfolio. Okay, that's the first thought. The second thought I've just said. You want a safe haven asset, treasuries, particularly if you're a dollar institution. Third driver is inflation protection assets. TIPS obviously are there, but private real estate, private and public natural resources, infrastructure, timber, those are the things that help protect the value of the endowment long term if there's unexpected inflation. And then, of course, there's a fourth leg to the whole picture, which is uncorrelated strategies. And many people refer to them as the absolute return portfolio, which hopefully are truly uncorrelated. And, there's the best way to know if they are uncorrelated is if you build an absolute return portfolio and on paper it seems uncorrelated, let it go through an equity crisis and see if it actually performs as it should be. Fortunately, there's been mini crisis since 2008, like 2011, where that can be tested. So those are the basic tenets. You have to then find the right mix of these drivers that allow you to contain, in our case, the maximum drawdown that we're able to sustain in order to actually achieve the objectives I mentioned earlier, while keeping the real value of the endowment in perpetuity. And that actually, as I said, is not an easy thing to do. So, how do you implement this? Well, the most important thing, as we found, or several things help us implement this. One is we try to maintain discipline in everything we do related to the SAA. We are a small team. We are relatively large endowment, quite large actually, but it's just 15 people managing investments across all of the geographies and all asset classes. Small teams make better decisions. I think that's something that in the course of my career I've come to realize as a pretty backable conclusion. Sometimes, you have to cut corners because you don't have as many resources, but that's a very important part of our implementation strategy, because when you have a small team, with some very senior people with a lot of experience, we have a lot of delegated authority, which is very important. If you don't have delegated authority, you're in real trouble to execute this kind of strategy anyway. Then, a small team can actually think about not just their particular asset class responsibilities, private equity, real estate, etc. They can actually think about, how it fits in the broader portfolio. And for us, that's very important. And one of the things that I did when we set this up in 2010 was to say, okay, we're all going to have the variable part of our compensation. It's going to be not on how so-and-so does, but partly on that, but mostly on how the overall endowment does. And because we're a small team, we meet 2 or 3 times a month. We have specific meetings to discuss different things, where everybody really has a view on what's happening in the other portfolio. And they're all well-informed people with many years of experience, so they can actually give help and also own, which is the most important thing, own the overall portfolio. The other important thing is we have an independent team, which is badly called risk team. It's really risk and strategy. It's the opposite of a policeman. It's actually people that are, again, very quant maybe, but their job is to have an independent view of what we're doing when we're adding assets or managers to the portfolio, and tell us what it means for the overall portfolio. And to make sure that we keep within those parameters we've established ourselves, so that we keep disciplined in terms of the percentage of risk drivers that we have over time. Now, to do that, frankly, given the complexity of the portfolio, we have invested a lot in having a data and management and risk management infrastructure, which, frankly, I'm amazed at how rapidly this changes. So everybody out of the desktop can actually do things immediately, can slice and dice the portfolio in many different ways, and therefore, find answers to questions which before, you had to go someplace, have things been run, etc. Now it's actually very easy, very user-friendly, and it's very important because in some sense, actually, as I said before, it makes it part of the overall endowment management decision. All right, so that's basically the fundamental aspect of how we approach the portfolio construction. And our job is to add value through manager selection, unless you have strong tactical views where you can hopefully then add value through deviations from this neutral SAA position. But let me talk about, this is a good segue in talking about the environment. Most of the people in the team are skeptical about the ability to add consistently over time value through tactical decisions in the kind of job that we do. We're not, day traders, etc. The kind of job that we do is really very difficult. And many times, if you actually happen to do the right thing, is more luck than skill. Now, in the current macro environment, which we can call it, just for a short word, to use a short word, the tough macro, so low rates, low returns for longer, it's even more difficult because the world is no longer cyclical. Before, people could more or less rely on the fact that there was a lot of cyclicality, and therefore, with some advantage about understanding how some things happen at the more granular level in the markets, you could actually maybe anticipate certain things and maybe think that you can actually add consistently over time value through tactical positioning. I think that's actually practically impossible in the current macro environment, where really nothing is predictable, because all of the policy instruments that are being used in a very heterodox manner. And when policymakers are themselves actually discovering and experimenting, never better use the word, with different things in order to get the objectives they're trying to get. And for example, one thing that just struck my mind, you all heard more recently how everybody is in favor. Policymakers seem to be in favor now of increasing infrastructure investments and making policy proactive tool well, think about what the same policymakers or their predecessors said in 2009, 2010 with regard to expansionary fiscal policy. That was anathema. Expansionary fiscal policy was basically was in the face of the Washington consensus. No, you have to actually reduce deficits and cut. And therefore, the only thing that remained was monetary policy, and therefore monetary policy went completely out of whack. So, 6 years down the road, they realized that, well, maybe it wasn't such a great idea to leave all of the burden of the adjustment into one policy instrument, and maybe we have to do something with the other. Well, I think we would be in a very different place today had we had taken that decision in 2009 rather than in 2016. But anyway, history is what it is. I think this is just a segue to saying, don't think that anything out there will follow any historical rules on the macro side. So why even try to be tactical about this? You're bound, if you win, you're bound to be just lucky. So that's on the tactical part of adding value for the team. Now, the other element I think that's important is to look at related to the environment is, well, you have a neutral strategic asset allocation that I just described very briefly in broad terms how you come up with, right? But implementing that in the current environment is challenging because in reality, one thing that has happened that has thrown a lot of sand into the process is that the typical valuation models that practically everybody in the industry was using are really out of whack. We have internal valuation models. We've compared results with JP Morgan, Goldman Sachs. They're very similar. And basically, some of them are mean reverting, the other ones are cyclically adjusted. It doesn't really matter. At the end of the day, I'm just going to give you an example to what extent valuation models, which are really very important because that feeds into a lot of the decisions that people take regarding what strategic asset allocation they should have and how they should move it around. And let's all understand, the SAA decision determines 95% of your returns and your risk. This and the implementation is the other thing. I mean, you can actually badly botch it up, and then, that's a different matter. But it's the key decision, right? So I just looked at what date where did our valuation models start to register fixed income. In our case, as I said, it's only treasuries, as overvalued. And overvalued only is when it's 2 standard deviations away from what the model considers fair value. And we have a variety of models, so this is the average of what the models were giving you. And it was January 2012. So, tactically, you should have been out of it if you want to be tactical about it. Now, we all know what happened with treasuries, right? 30% return since January 2012 until now. It's just an indication that something out there really is not working as it used to work. And sadly, what used to work is really what informs what a lot of the quant frameworks and infrastructures are there and are currently still in use. So, why am I digressing on this matter? Okay, well, because it does have a pretty important implication on how you consider your neutral position. Well, and here the neutral strategic asset allocation position. So I've just said that I really don't believe you can add value tactically. Okay, but the second question is, do you think you should, because of the environment, change that neutral SAA position? Okay, and then secondly, even if you think you don't want to change it, do you think you should change the way in which you implement the neutral SAA position? I think that's an interesting question that we should just delve a little bit about. Now we'll take the second one first instead of the first one. On the equity side, on the equity driver, the famous words "will do whatever it takes" actually are pretty solid and have really changed a lot of things in the world. And we've only seen that as instruments were not working, policymakers did something the next time more bold to make something work, which for them is really maintain equity valuations. Because, equity valuations maintain real wealth and therefore maintain spending power, and hopefully that gets the economy or growth going. So, not a good thing to bet against policymakers, even if people out there say that the policy instruments are, faded and they don't have power, etc. You can have central banks buying equities directly. Japan does it already. So you have to be careful with that. I think so. Maintain the equity allocation, because even if you think it's overvalued, there is a lot to be said about not wanting to go against, as I said, the perceived policymakers' view, which, by the way, for the first time in many years, I think for the first time ever, is fully coordinated. So although they're a little bit out of sync, or somewhat out of sync, certainly out of sync compared to Japan, Europe, and the United States, the idea behind what they're doing is fully coordinated. Everybody's behind the same idea. You have to maintain the value of equity markets, right? So that's one thing. Now, how do you implement it, of course, matters. You can go more into illiquids if you have the ability to do so. Now, for us, we have to obviously take into account how much liquidity we can bring on the portfolio. We've been very successful with our illiquid portfolios, but there's a limit as to how much we can put because of our demanding liability. But and within that, you can look at are you happy with the family of unicorns increasing or doubling practically every year? Well, maybe you should be careful about venture, right? We only invest with 5 venture firms or 6 venture firms, which have been the venture firms that have been around since 1970. You think that it's difficult for somebody that's new on the block to have access to these names. The reality is, where we were before, the pension plan of the World Bank had been investing in private equity and venture since 1980, and those relationships are carried with the person and with the team. So fortunately for Gust, they brought on people that allowed them access into things which, quite frankly, are pretty unthinkable for a newcomer. But anyway, that's a thought. So you look at what goes into the growth driver. So you might want to maintain developed equities, but given valuations, and I've just said how difficult it is to make adjustment on that. Do you want to have more emerging market equity versus developed equity? Do you want to have less venture, more private equity? These are things that everybody will. Decisions or trade-offs you can consider, and everybody will. There's no real solution, or there's no one answer to it. There's certain things out there that point in one direction. We all know in the direction in which it points, so I don't need to specify what it is. Only just be careful, because the normal instruments you've been using to reach that conclusion are maybe not working as intended. Okay. Let's go into the fixed income risk driver. Now, that's an interesting one, right? Because everything is now really out of whack. I mean, 1/3 of developed bond holdings are in negative territory. Now, for the longest time, we thought 0 was the floor. Well, 0 is no longer the floor. And one thing that I've seen happen with many people that really had not much choice, because they have to hold a lot of fixed income, and I'm talking particularly about pension plans with 30-40% of 100 to 100 billion portfolios, they've gone into credit. Because, with credit, you sort of... It's a way of not making it very evident that a bulk of your portfolio is actually at negative rates. And the other is sort of, very complicated for us to consider anything like that. Why? Because it goes in the face of one of our main tenets or principles, which is you want to keep risk drivers clean. Credit pollutes the function of fixed income in a portfolio like ours. Fixed income is safe haven. You can't have credit. Credit behaves like equity. If something really bad happens in the equity markets, they will be hit. So, I think that's a very dangerous way in which people play tactically. I've just given you my view about tactical play, so I won't enter into that. But that's a difficult way to go. Real estate and infrastructure. I think that's actually, you've seen, particularly by large pension plans that now do a lot of club deals in infrastructure, and also sovereign wealth funds, which have been involved more or less for a while. You see there's a lot of activity in that regard. Unfortunately, now getting very crowded. But I think it's a very interesting, it's the realization of many people that had allocations to fixed income that maybe they didn't need all that amount of liquid fixed income for the kind of liquidity requirements that, the payments they need to make to the pensioners, etc. Maybe they could afford a bit more illiquidity, but they want, a similar type of protection, a similar type of risk behavior. Is not the same, obviously. and in a bad equity market, it'll be, won't act as safe haven. I think what it means in the case of where people are making those choices is they're consciously reducing. They're actually not going to the old neutral. They're consciously reducing the fixed income allocation and increasing real estate and infrastructure because, for income producing purposes, they're a much better alternative. And maybe because they also think that inflation protection is something they should think about. And I'll say a few more words at the end about that, because I think that's the important idea. Third thing you see people doing with fixed income is people going to cash. I mean, I've seen a number of not a number, but a couple of foundations that have had cash percentages above 10%. That's a very high percentage for a foundation, or for an endowment for that matter. And it's a very difficult position to maintain from a governance point of view. When you think about boards looking at quarter after quarter in the report, a 10% allocation to cash. I wouldn't be critical about it, but the reality is that although people think about foundations and endowments being long-term, the board meets quarterly, right? And average tenure in a board is maybe 4 years, 5 years. So at the end, I think the only long-term investor, is our family offices. They have no liability. The families don't live out of the cash of the family office. They used to be sovereign wealth funds, but now all of a sudden with oil prices where they are, they have to now pay or they have to now draw liquidity from pools of assets that they never thought they had to do. So in reality, we are in principle long-term investors, and we actually certainly set ourselves up to be that way. But you have to be mindful that there are governance constraints that can, throw sand in the way and make it difficult for you to maintain that. But anyway, that's an option as an alternative to fixed income. Absolute return, it is a very interesting option. Again, it's more a decision of reducing fixed income and increasing absolute return. In our own experience, and we are pretty purist about the absolute return portfolio, which has no equity beta, it had less than 0.05. And it has gone through the equity crisis, and it has behaved properly. So I can testify that at least in our experience, that portfolio has managed to achieve what it's supposed to achieve. Which is no correlation to the equity markets. But, it's very difficult to get the right combination to maintain it over time. And B, not for us, but for a number of people out there that invest in absolute return hedge funds, and you see the headlines, CalPERS selling the hedge fund portfolio, New York pension plans selling the hedge fund portfolio. They are disillusioned because they're not providing the return they thought they would provide. Well, hedge funds are not there to provide return of 7, 8, 9, 10%. It's LIBOR plus something. Whether that number is 3 or 4 or 5, it depends on the risk you take on the underlying strategies. But it's and LIBOR is 0, right? So it's 3, 4, 5%. And if you're not happy with that, and if you're investing in hedge funds absolute return portfolios for return, you're doing the wrong thing. So, but anyway, I think that's an interesting alternative that I see happening among some of the investors, and one that is not growing more because of the short-sightedness of the hedge fund industry in not adjusting their fees. And I just say here, so as an aside, the 2 is an historical accident that happened to be very convenient for a lot of people. There are very few hedge funds out there that actually earn their 2 and I think everybody lives now married to this idea that hedge fund industry is going to be one of boom and bust. At some points in history, there'll be a lot of money pouring in. Everybody will pay in 2 whether they deserve it or not, and then at some points everybody was selling off, and then hedge funds will close. Even some of them that maybe they shouldn't close down, but they can reinvent themselves, right? They close down the office here, they open a year later across the street. So I think the hedge fund industry, unfortunately, I'm a little bit pessimistic as to getting any sense into it, but the alignment of interest is not there for most of the part, and you don't really have a muscle. Even if you're large, you don't have very much of a muscle to deal with these huge flows that come from investors that don't really care too much about that. They're really less informed. So anyway, I've talked about the equity component. I've talked about alternatives to that and what to do at the granular level. I've talked a bit about the fixed income. I also talked about real estate. Well, real estate, there are two things that actually make an endowment different, apart from the very different liability. One is that we have a high, and I should have mentioned that before, we have a very high bar for active management. We think in developed equity, for example, it's very difficult to find managers that consistently add value over time. We're not afraid in buying an index. Some people, particularly in endowments with certain prestige, look at indices in their portfolio and they think these people are not working, just buying the index, right? Well, it's very difficult to buy the index and be disciplined and not investing in adding managers. It takes much more stamina and discipline to actually do that, and we're quite happy in doing it. The other thing that makes us makes us different is that in our real estate portfolio, half of it is direct. Although we're a very small team, we managed to actually tie up with local operators. And basically, why is it important to be direct in real estate? Because if there's anything that's cyclical, is real estate. And even the best real estate managers will have to sell at the wrong time because they're raising the next fund. And they can't really control the timing. So if you are a direct holder and you have control over the exit, it's a critical decision to be able to actually make the decision of to add value in that asset class over time, because you control one of the most important elements of the overall value creating operation. The other thing is you can also control other parts of the operation, like the financing side of things, which can be very important in diminishing the risks of real estate. Like, for example, you can get fixed rate 10-year financing in the United States at ridiculous rates. But a lot of real estate companies and real estate funds go out and just get floating, tie over 18 months, 24 months, because it makes sense given their time horizon, which is actually only 3 to 4 years, maybe 5 years. So, by doing things like that and having that approach to real estate, you can actually get rid of a lot of risks that are associated with it, and you give much more value to that strategy. So that's in the inflation risk driver bucket. I think I probably should just be brief now. I want to leave one final thought, which is, I talked about, you have the neutral position. Do you change the neutral position? We talked a bit about, some calibrations that's being done. In connection with that, I think this is not a popular idea, by the way. I'm just telling you already. If you think about how are the issues at the broader macro level going to be actually resolved? And by these issues, I mean the very high debt levels, the implementation of deleveraging, the very high and increasing pension liabilities, etc. There is just, you can take these like pension liabilities, you can try to go and try to negotiate lower benefits, etc. Just imagine what you have to do, what sort of political costs and what the outcome of that would be. Deleveraging, you can try to cut and etc. Very complicated. There's one thing that will reduce these two, which I mentioned two, but there are others that are affected in a similar way, elements which actually are important to get rid of, to be able to set the stage for greater growth in the future. And that's inflation. Inflation doesn't need congressional approval. Inflation happens. It's difficult to create. And I'm sure that a lot of the policymakers say, if we knew, etc. Well, maybe now, with this change in fiscal policy attitude, you'll have a better chance of creating inflation. And inflation, in a very socially unfair manner, I should say, actually gets rid of a lot of these problems in the macro side. And from an investor point of view, maybe therefore, and here you have to really take a long-term view, because who knows when that will happen. Maybe it's the right time to think about, do I have the right inflation-protecting assets in my portfolio? And is this the right time to actually add to them? They're not very popular right now. I mean, real estate is, but other things are there not terribly popular. Natural resources, for example, gone through a major crisis. You can probably find things in distress, even timber and so on. So anyway, that's just one parting thought.
Very good. Sindo, thank you.